Good day, everyone. For today, we are going to tackle about one issue or lesson in IFR's three business combinations that caused confusion and, let's just say, more debates or topics or clarifications in advanced financial accounting and reporting, especially by learners like us. So allow me to discuss this to you by showing to you this particular graphic or graphical interface or GIF on your respective screen. And you can actually see a movement. So there is a private company or acquirer or buyer. And then the private company merges into the public company or shell or target. Now, before we discuss reverse acquisition in accounting perspectives and computation, so allow us to define terminologies first. Now, if we say a private company, this means that this company does not have shares issued to the public and registered through Securities and Exchange Commission or SEC. So we all know, or I hope that we do know, that for us to be able, as companies, of course, or corporations, to be able to issue shares, we have to register to Securities and Exchange Commission. So if we are able to make our articles of incorporation with our discussions from partnership and corporation accounting and the law on partnerships and corporations, we know these things. Like from articles of incorporation, we have to indicate on that particular legal form as to how many shares we are authorized for issuance. So we also need to get the license or secondary license, that is for us to be able to issue shares again from Securities and Exchange Commission. So that's how we will become public entities. But if we did not or we do not, then we are going to become or we are going to be just private companies then. So that's how private companies differentiated from private or vis-a-vis with each other. So private versus public companies. All right. So again, as being said, to summarize, if we say private companies, these are companies in which their respective shares or stocks, if we are talking about corporations, because business combinations would normally deal with corporations, so they are not issuing their shares or we are not issuing our shares to the public. Whereas clearly, if we say public companies, then these are the corporations in which the shares or stocks are issued to the public. All right, so that's how to differentiate the two terms. Then we can see here the annotation at the bottom that in reverse acquisition case, private company intends to buy public company. So this is the setup, private wanting to become public. However, the private entity wouldn't want to undergo the scrutiny and the complexities of the requirements, legally speaking. So that's why for it to become public, it will allow a public company or shell or target to acquire it. But the private company actually initiates the acquisition. So that's how the reverse acquisition would actually be there, conceptually speaking. Though the public company or public company is a surviving entity, consolidated entity operates by private entity, because we will know later on that this private entity actually is the acquirer or buyer, despite the fact that it seemed initially under the contract, it is the public company or entity or shell or target that acquires the private company, legally speaking. So this is also the importance of knowing or going back the concept that is substance over form, in our accounting subjects, wherein we do not just literally look at the contents of the contract, legally speaking, or in legal terms or tenor. We also have to analyze in accounting because this is an accounting subject. Okay, so much for that. Allow me to show to you our source then. This is from the book of Milan, all about reverse acquisition. So hopefully it's viewable now. Reverse acquisitions, as explained, the entity that issues securities, that is the legal acquirer, is identified as the acquiree for accounting purposes. So we say then that the legal acquirer is the accounting acquiree, while the entity whose equity interests are acquired, that is the legal acquiree, is the accounting acquirer or the acquirer for accounting purposes. Normally, if we say acquisition or business combination, which is the conventional or the usual or normal acquisition, remember, it's so simple, it's so straightforward. The parent, also known as the acquirer, acquires the acquiree or subsidiary. And that's how simple it is. However, the opposite is true for reverse acquisitions, hence the term reverse acquisitions. By the way, some finance books or financial management books would be using the terms reverse merger or reverse takeover, and those are similar terminologies for reverse acquisitions. Now, going back as an example, let's say ABC company, that is a private entity, wants to become a public entity but does not want to register its shares. So this is normally the setup. The advantage of this reverse acquisition is that whenever a private entity wants to become public, it can do so by arranging with a public entity, and then such private entity would be acquired by the public entity under the terms of the contract. And the advantage is that such private entity would not go into the complexities of the usual requirements that are to be taken to become public. So the filing of the registry requirements to Securities and Exchange Commission in the Philippines and so on. So swift process, minimal risk, and it is less expensive. However, the disadvantage could be is that there could be some possibilities of fraud because this is an easier way to do the merger takeover by doing the reverse one. So remember, it does not, the it here is the private entity would not have to undergo the requirements of becoming public office-wise with SEC. So there would be lesser paper trail to begin with. When we say paper trail, so lesser documentation and so on. So fraud can easily happen. And then there could be some lawsuits later on for various reasons, which could occur because of the reverse merger. So let's say because of fraud, fraudulent transactions, and then there would be some complaints or lawsuits filed. So that can result to disadvantage on the part of both entities. So not only with the private entity, but also with the public entity that is acted as the one to acquire the or the private entity. All right, so that's how it goes. And then to proceed, the entity that issues securities, as what we've said, is normally the acquirer. So that's a setup, legally speaking. If you look at the document itself, that ABC company, just like in the example, for example, would be wanting to become public but does not want to register its shares. And then to accomplish this, ABC will arrange for a public entity. Let's say in the subsequent example, this is XYZ company or incorporated is the legal subsidiary or the accounting acquirer. So this is the entity then that is legally speaking is to be acquired by ABC company, that is the legal parent. So ABC company is, in this example here, subsequent one, is the acquirer, legally speaking. So it is made into consideration in such a way that it would issue shares to acquire XYZ. However, in essence, it is XYZ that actually acquires ABC company. So this is the private entity that acquires ABC company. It is because XYZ is the one initiating the said reverse acquisition, even if it does not issue shares. So that's the point of this one. Anyway, so I mentioned ABC company, but that would like change in the subsequent example. So we just have to be careful. So whatever the name of the company here, so let's just erase that to avoid confusion. So let's just say a private entity wants to become a public and it does not want to register its shares, so it arranged with the public entity for it to be acquired. So in this case, then the private entity is the legal acquiree because it is again to be acquired contract-wise, legally speaking, by a public entity. So legally speaking, it is the acquiree and the public entity is the legal acquirer. However, accounting-wise, substance over form, the public entity actually becomes the acquiree and the private entity becomes the acquirer. So I guess this has to go with the way with the wordings of the standard. The private entity initiates. To accomplish this, the private entity, I will erase ABC, arranges for a public entity to acquire it. So in that case, it has the intention actually to acquire actually a public entity for it to be able to become a public entity. However, it cannot do so like immediately. So that's why it then allows under the contract a public entity to acquire it. But the intention is really with the ABC. I hope it gets the point there that ABC really is the accounting acquirer, which is the private entity, and the public entity is the accounting acquiree. So just think of the opposites, guys. That's why this is known as a reverse acquisition. So public entity, legal acquirer, so accounting acquiree. Private entity, legal acquiree, so accounting acquirer. Again, think of the reverse. Hence the term reverse acquisitions. Anyway, this does not happen normally. So this is like an additional input in addition to conventional or usual business combinations or acquisitions. All right, so however, when applying the guidance provided under PFRS 3, business combinations revised, so we all know these things now. We think of the opposites. Next, how do we measure the consideration transferred? Normally, if we think of the conventional or usual business combinations or acquisitions, remember guys, we just analyze the problem, look for the details of what were the considerations or the values transferred by the parent or acquirer in order to acquire the acquiree or subsidiary. So that's how it goes. And we are going to use the fair value of these considerations transferred by the acquirer. So if this is the usual or normal or traditional or conventional business combination or acquisition, remember the basis would be the consideration transferred by the acquirer, that is the acquirer both legally speaking and accounting speaking or accounting wise. So no confusion. If we say parent or acquirer, and then on the other vein or end or spectrum or end of the spectrum is the subsidiary or acquiree. So both legally speaking and economic or accounting wise, those are same terms. But in reverse acquisition, here is now the thing that we are going to think about. So whoever is the legal acquirer is the accounting acquiree or subsidiary. So legal parent or acquirer, and then at the same time is the accounting acquiree or subsidiary. And then the question would be normally who is that, like the legal acquirer or parent, and then the accounting acquirer or subsidiary normally in this case is the public entity, because remember the public entity is arranged to issue shares assuming to acquire the private entity, for the private entity to become public. So the private entity then is the legal subsidiary or acquiree, but is the accounting acquirer or parent, because it makes the negotiation and it has the intention to really have the acquisition. All right. So going back, how do we measure the consideration then in a reverse acquisition? This is quite technical because the acquisition date fair value of the consideration transferred by the accounting acquirer, that is the accounting subsidiary, or this is the legal acquiree. So this is the legal subsidiary, right? So legal subsidiary then. Anyway, so accounting acquirer or the accounting parent, of course, the accounting acquiree here is the other entity on the opposite end. So as said, if this is like the accounting acquirer as the wordings here in the standard, so the accounting acquirer or the accounting parent, and then at the same time is the legal acquiree or the legal subsidiary at the opposite end. And if we are to analyze this further on, we would know that the accounting acquirer, of course, or again, the accounting parent and the legal subsidiary and legal acquiree at the same time would be the private entity, because it has the initiation, it has the intention of acquiring. Then shall be measured as an amount based on the number of equity interests the legal subsidiary or accounting acquirer, that is the, so this is the private entity, would have had to issue to give the owners of the legal parent or the accounting acquiree, this is the public entity, the same percentage of equity interest in the combined entity that results from the reverse acquisition. So this somehow like become confusing at this point in time, but will be expounded as we go along the way. Anyway, if you may allow me at this point in time, so we'll also have to realize though that the accounting acquirer again here, or the private entity, will have the consideration such that it is as if it issues shares because it is the acquirer, although it does not issue shares. Actually, it is the public that issued shares because it is the acquirer legally speaking. So like by contract, we would see that it issues shares. So that's why in accounting, we just assume that the acquirer or the private entity issued shares then. So it would be that amount that it would have issued so that the owners of the legal parent or the accounting acquiree, that is the public company, would have also the same percentage of equity interest in the combined entity that results from the reverse acquisition, especially on the part of the private entity. So meaning to say, whatever is the percentage that is on the basis of the accounting acquiree should have been the same to the accounting acquirer. So accounting acquiree is actually, again, the public entity, and the accounting acquirer is the private entity. So we are going to look into as to the way in which the percentage, if we combine both entities, would be the same in both analysis. So we'll be seeing that analysis though later on. All right, so here is the comparison of conventional acquisition versus reverse acquisition. So as said, in conventional business combination, there is no doubt that the accounting acquirer is the one that issues the consideration, and that is also the parent. Whereas in the reverse acquisition, the accounting acquirer issues the shares. So again, the reverse word. For the combining constituents, remember whoever is the acquirer is also the parent legally and accounting wise. But for the opposite in a reverse acquisition, the legal subsidiary, that is the entity that is in the contract as the one to be acquired, is actually the one that acquires. So in this case, this is the private entity. It has the intention, but then it cannot do so to acquire a public company because its intention is for it to become a public entity. Then the accounting acquiry or subsidiary, accounting and legally or legal aspect, no question as to the conventional acquisition. But in a reverse, we again think of the opposite. So accounting acquiry or legal parent is the public entity. How do we measure the consideration? So fair value, whatever that is, whether cash or non-cash or both or with contingent consideration. So that's it for conventional acquisition. For a reverse acquisition, also known as reverse merger or reverse takeover, it will be the fair value of the notional number of equity instruments that the accounting acquirer or the legal subsidiary, that is the private entity, would have had to issue to the accounting acquiree. That is the legal parent, and this is the public entity to give the owners of the accounting acquiree or the public entity the same, again, legal parent, the same percentage ownership in the combined entity. All right, so we will realize this based on the example. So the lesson here is that whether or whenever the contract has stated that this is the parent or subsidiary, we just have to go into the details and analyze it using economic substance over legal form. And therefore, we have to follow the formula of computing the goodwill or gain on acquisition, in which that would be the consideration transferred by the acquirer accounting wise, less the fair value of identifiable net assets of the acquiree accounting wise, not the legal aspects. Despite the fact, again, that the legal contract would have said that the acquirer is the public entity, and then the acquiree, legally speaking, is the private entity. No, we are going to look into the substance in which the acquiree, accounting wise, is actually the public entity because it is the one in which it acts as the basin or the reservoir, so that the parent accounting wise, in which no consideration is transferred by the private entity, just issuance of shares, would have made it become public. So that's how the setup is being done. So the intention is very important here also. Example, so let's say XYZ Incorporated, which is an unlisted company. This is the private entity. Another lesson here is that this is also another word for a private entity, and that is an unlisted company. So it acquires ABC Company, a publicly listed entity, through an exchange of equity instruments. So here it's clear by the wordings that XYZ Company is the one that acquires. So private company, accounting acquirer, and it is the legal subsidiary. So the point here is that XYZ wants to become public. So that's why it acquires ABC. However, for sure, the setup would be that ABC would acquire XYZ so that it would be easier for XYZ again to become public. And then ABC would issue shares, 5 shares in exchange for each ordinary shares of XYZ. Incorporated. So probably XYZ is a big company because ABC would be issuing really 5 shares. So more shares in exchange for each ordinary share of XYZ. And then all of XYZ's shareholders exchange their shares in ABC company. And then let's look at the details. Remember that XYZ has 8,000 shares. XYZ is the accounting acquirer or legal subsidiary. And then ABC, that is the publicly listed company, the accounting acquirer or the legal parent, issued shares. So we would be seeing here somehow a disparity, or let's just say something that is not aligned. Why do I say so? Remember, XYZ, the unlisted company, would acquire ABC. Isn't it that the acquirer, XYZ Incorporated, would have issued the shares, not the opposite? So that's why this is also a clue here based on the wordings that this is a case of a reverse acquisition, because the acquirer supposedly, XYZ, would have issued the shares, but then the acquirer ABC, accounting wise, is the one that issues shares. I hope that is also clear. So this means that ABC company would be issuing 40,000 shares in exchange for all 8,000 here, 8,000 ordinary shares of XYZ, this column, times 5, that's 40,000 total. And then the fair values of the shares of each. Remember, it would have been the fair value of the acquirer that would be used, right? However, in the analysis later on, still this would be utilized. Remember the consideration discussed here, that this is on the part of the accounting acquirer, and that is the private entity or the legal subsidiary as said, but well, we go to accounting. So here are the details from statement of financial position, and then we will assume that the fair values are equal to the carrying amounts. To simplify the discussions, requirement is to compute for goodwill or gain on bargain purchase or the gain on acquisition. So analysis, XYZ Incorporated acquires ABC company. XYZ Incorporated acquires ABC company, and then it's ABC company that issues shares. So in that case, really, the point is that XYZ, being an unlisted company, wants to become public. And that's why ABC is allowed to issue shares in this case for XYZ's purposes or reasons of doing so. So XYZ Incorporated lets itself be acquired legal form for it to gain control over the legal acquirer, and that is the substance of the transaction. So the legal acquirer is ABC company, that is the public entity, and it is the accounting acquiree. While XYZ Incorporated, the unlisted company, acquires, based on the wordings here, unlisted, that is the private entity, is again the legal acquiree, but the accounting acquirer. Okay, the legal subsidiary, but the accounting acquirer in that case. So I need to repeat the term so that we will not forget. So this is the private and this is the public. And this analysis, so XYZ being the private entity, wants to be acquired by the legal acquirer ABC company, that is the accounting acquiree. So again, it does not jive because the accounting acquiree issued shares then. Legal form, ABC company issues 40,000 shares to acquire XYZ. So the public issues shares, but it was XYZ who wants to acquire. So again, a reverse acquisition. Substance, XYZ gains control over legal acquirer or the accounting acquiree, that is the public entity. So by doing the reverse acquisition, the private entity gains control under IFRS 3 business combinations over the public entity. So in fact, it now has 80%. And you can notice in this analysis, so remember ABC's issued shares here, it's 10,000 based on this illustration, that's 10,000 shares. And then shares to be issued to XYZ, 40,000 for a total of 50,000. So ABC company again supposedly is the legal acquirer, but then it issued the shares, right? So a case of reverse acquisition, 10,000, 40,000, 50,000. Why do I say, by the way, this is a case? Also, I said here, because again, the acquirer, supposedly legally speaking, should have been the one to issue shares, but this is ABC. And then it is the accounting acquiree. Okay, so when computing for goodwill on a reverse acquisition, the consideration transferred is computed based on the number of equity interests the legal subsidiary or accounting acquirer, that is the private entity, would have had to issue to give the owners of the legal parent or accounting acquiree, that is the public entity or company or corporation, the same percentage of equity interest in the combined entity that results from the reverse acquisition. Remember, this is the result. So by issuance of ABC for 5 of the shares of XYZ, so it actually created like 80% ownership. So XYZ owns 80% now of the total company. And then the consideration then is computed based on this one. Remember, the existing shares of XYZ issued is 8,000. So for it to have the same percentage overall, that's 80%. So we have to divide that or gross up by 80% to become 10,000. And so that the issued additional shares then of XYZ is 2,000. And then 2,000 shares multiplied by the fair value of XYZ. Remember, I told you a while ago that although it was ABC that issued the shares, but then ABC company, that is the public company, is the accounting acquiree, right? It is the legal parent for contract, but accounting wise, it is the accounting acquiree. So again, why is it the legal parent? It is because it is allowed, it is being directed to acquire or issue shares to acquire XYZ, but in fact, it was XYZ who has the intention to acquire. So that's why ABC company is the legal parent or acquirer, but it is the accounting acquiree. So that's why it is the accounting acquirer's fair value will be used. So 200 pesos. And then that's why we have it here, 2,000 shares from here also. I'm sorry if I keep on moving, but this is how we can discuss this well. Scrolling up and down, so 2,000 shares, additional shares to be issued to have the same interest in XYZ incorporated. So the parent will now have the same percentage. So the XYZ, which is the accounting acquirer, that's the private entity, will have this ownership in ABC company, that is the public. So we want also that the public entity, which is the accounting acquiree, will have the same also ownership, percentage of ownership in XYZ, that is the accounting acquirer. So meaning both will be balanced by this case of reverse acquisition. So this is the unique thing under reverse acquisitions, by the way. So in this case, 2,000 times 200 is 400,000. And you can notice that this is also our basis in computing the goodwill. So 400,000 consideration transferred, no NCI, no previously held equity interest in the acquiree that needs to be revalued to fair value, less the fair value of net identifiable assets of the acquiree accounting wise. Who is that? That is accounting acquiree is the public entity, ABC company. So 1,600,000 minus liabilities of 1,300,000 equals 300,000 equity. And so that we get goodwill of 100,000 pesos. One question that could be asked here is that why is it that there is no NCI? Remember, that's 80% of the identifiable net assets of the acquiree. Accounting wise, that is again the public company. Well, as said a while ago in our discussions that there's no actual movement of any consideration like cash or non-cash. This is just a matter of as if there is something that is being transferred consideration wise. So remember, we just had the notional amount of this one, like we just had computed this based on 20%, 80% relationship of the two, so that in both entities it will be balanced. And this is the case of reverse acquisition. So that's why there's no NCI, because if this is a traditional or conventional acquisition, for sure there will be NCI because we did not acquire 100% of the entire company's equity interests. All right. So hopefully you've learned something from this session involving reverse acquisition. And then make sure to check out our other discussions involving consolidated financial statements. And then for this case, it's consolidated statement of financial position at the date of acquisition. Next stop would be subsequent to date of acquisition. Then I'll see you next time for another one. Thank you and God bless us all.